Nothing can stop me. I'm all the way up. All the way up. I'm all the way up.
Is this plant real?
It's as real as it gets.
Right.
Looks real, right?
Green for money?
Yeah, it's green for money. That's right. Hello, everybody.
Good morning.
Good morning,
Oh,
Vietnam.
thank God.
There
couldn't
it is.
I couldn't start my day without it.
Welcome to the Money Matrix podcast, where smart money finds a smarter way. I'm Meyer Dalal.
Ronan Fishman.
Jay the Bird Manzioni.
Yes,
Bird.
sir. The bird. That's he's feeling good about himself today, so
Oh,
he's
is
got
that
the
right?
bird going on.
Yes, sir.
Listen, we got some color. We got a lot of feedback that our walls are bare, so we got some stuff coming probably in the next week or so. So we're sprucing it up.
Yeah, that and the viewership, like exponential growth. I mean, it's good. It's good.
We're doing good. So today's topic, a little bit controversial. I know you like controversial, Ronan.
I
so
live
we're
on
going at it.
controversy, buddy.
So we're going to talk about the shadow inventory, what it is, and why the big banks don't want you to know about it.
I have issues with the logic, but I heard about this before. I know that I've read about it a little bit because it just went down a rabbit hole. But I don't know. Let's
Do you
figure
know
this
what
out.
shadow inventory is, first of all?
So I do in theory, but I don't understand it in practice.
So basically, what shadow inventory is, large banks, Bank of America, Wells Fargo, Citibank, all of your Chase, all of these premier large banking institutions that hold majority of the paper that's out there, the conventional paper at least, you know, that are the end investors and are the ones that are financing all of this, mortgage industry
Fannie
as a
Freddie.
whole. Yes, but ultimately it goes all the way down further, and you have a lot of these larger banks that are holding and servicing, not servicing, but holding the paper, and they're getting their payments on it. When foreclosures happen, people go delinquent, you either have to take it back and sell it right away, or you hold it on your books. In 2008, when the housing bubble happened, they had 3 million homes. So they couldn't really hold 3 million homes, and they had to start selling. But the concept of shadow inventory is they do not sell the properties all at once in big mass. They drip and drab, slowly dump the properties. So they maintain price integrity, they maintain the market. And unfortunately, it's a manipulation.
All markets based on manipulation in theory, right? I mean, it's all based on FOMO and spec and what you think the company PE ratios on any one stock, or what you think, it's worth 10, 100, 300 times X of
No, but
earnings.
this is the big banks are outright manipulating the market.
So you're saying they're holding it by design, or
By design. They are manipulating the market, the big banks. They are holding it by design.
but it's costing them to hold.
No. 22 months, homes have gone up every month, right? We just said it in the last podcast.
Yeah.
Up 3-4%. If they would have dumped your whole stuff to going back 2 years, where would they be?
Are foreclosures going up?
Yeah. So this is the interesting stuff, right? So if you look at the numbers right here, let me get you the numbers. 1 second. There are 3 million homes. So right now, so that was 3 million homes. Sorry, that was back in 2008. Currently, according to the Mortgage Bankers Association National Delinquency Survey from last quarter, mortgage delinquencies are up 15% year over year. That's a big number. Now, that's not including everything, right? Because if you're delinquent, if you go into foreclosure starts, they're not telling you the whole picture either. So we really don't know what the true numbers are. But what's happening, though, is they're taking these properties. Right now, they have 350,000 some odd homes. That's what they're estimating. No one really knows.
Held in inventory by big banks.
Correct. So what happens? They started noticing in certain areas in Houston, for example, one of them. But before I get into that, the U.S. foreclosure market report showed foreclosure filings increased 22% in the first quarter of 2025 compared to the same period last year. Yet only the new bank owned properties listings only increased by 7%. So if your foreclosures are up 22%, but only bank REOs, because they call them real estate owned, and they give them out to, call it, handful of REO realtors who manage the properties and go through a whole process of selling it and going through the you know, they end up making money on it, but they have to service it. They have to make sure the maintenance gets done. So their whole bunch of REO brokers who did extremely well back in 2008, 2009.
Did
10.
you get in on that?
No, I was always in the mortgage business, but I shifted my business when the market went down, and I was buying and selling non-performing assets and fixing them and reperforming them.
What does that mean?
So basically, we would take, my wife and I, an asset that for some reason was stuck on someone's books.
Asset being the mortgage.
Mortgage, yes, sorry. And for whatever reason, they couldn't deliver it to Freddie, Fannie, or Ginnie.
So you couldn't sell it on secondary market.
Correct. So they said there was an underwriting defect. My wife is an underwriter, so we would take those loans, fix them, make them work, and show them how they did fit the underwriting guidelines, and then we'd sell them back to Freddie, Fannie, and Ginnie.
So you basically took the underwriting that nobody wanted because they couldn't sell it in the secondary market, put it into the mortgage-backed security. And so let's say a bank gets caught with a dented loan,
Scratch and dent, exactly.
Yeah,
That's what we did.
So let's say it's a dented loan.
2009 to 2015.
What happens if you get it caught with a dented loan on your books?
So typically a warehouse bank gives you 60, 90, sometimes 120 days, and then ultimately it has to be bought off of the line. You can't just have an extended loan on there forever. So in this case, they have to either buy it off the line and use cash, or they have to sell it in the secondary market and take a discount.
So corresponding lender would have to close out the position 60 and 90 days, or they have to go in the secondary market and sell it at a discount. What kind of discount?
And that's a short sale?
No, it's not a short. No, it's not a short sale, because the short sale has to do with the real estate. This is the mortgage asset itself. So if par is 100, we would buy it at, call it, 95, 96. And then we try to sell it back to the larger institutions, Fannie Mae, Freddie Mac, back at 98, 99, depending on where it was, and try to make the spread.
What would you have to change or look at that?
It's just the underwriting approach. It's just people don't know what they don't know. And they just assume that just because your investor tells you it's not eligible, it's not eligible. That's not true. A lot of times they make mistakes. But getting back to here where we're at,
This
because
is fascinating.
yes,
dude.
we can do a whole
we gotta
other
do that. I
podcast.
don't know. What you been holding out on me?
We can do another whole podcast on that. But really, what's really crazy about this, it's a manipulation.
Yeah.
Because look, homes don't hit the market. Affordability is still a major problem.
Less supply.
First-time home buyers also have an issue, because who gets these? If they do sell them, typically it's sold to large hedge funds, REITs, at an off-market transaction. So it'll never hit the MLS. It'll never hit anywhere, and no one will know anything about it.
Private deal.
Correct. But if it does hit the market, it's slowly seeped in, little by little by little. So you're never hitting the market too much at any one point in time. But if you notice in certain areas in Austin, in Houston, in parts of Phoenix, inventory is hitting up high, it increasing in parts of Florida, the West Coast. Where's that?
Cape Coral?
Cape Coral, that where the hurricane hit.
Naples.
Yeah, not as much Naples. Naples is high end, but you're seeing a lot more inventory increase. Why is that? Because they're slowly seeping it in. It's not just because all of a sudden sellers decide to sell.
Right.
There's a combination of it. But people don't realize how damaging this is to the market, to the consumer, to everybody.
I mean, in some ways, it would also be positive, because if they flooded the market, you're going to now seeing overabundance of supply, less demand, and then obviously price points will find a new equilibrium. So, I mean, they're kind of protecting their own assets, right? The valuations, maybe keeping it arbitrarily high, but I think the alternative to that would be significantly worse if they were now flooding the market with all this stuff, and everybody's looking for affordable housing. Yeah, great, they can buy it, but everybody who's sitting on an asset now is taking a backwards hit. And then let's say now a DSCR loan that we did was worth $1 million. They flood the market on this stuff. Now it's worth $700,000. So the bank loses, $300,000 in security. Can you call that loan?
No, just because the market goes down. No.
Yeah.
The only time you can call an asset or foreclose on an asset is if
Default?
they're in default.
All right. What's the parameters of a default?
So technical speaking, if you're more than 120 days down on your mortgage, that you miss 4 payments, technically you're considered in default. And at that point, they can file a notice of default.
Okay. Then what happens?
So from there, it depends on the state, depends on the circumstances. But, I know someone in New York who's hasn't paid their mortgage in 10 years.
Yeah, how does that happen? I hear these stories. Even in Florida, that people.
No, Florida is harder. But literally, the guy, I know him personally. He hasn't paid his mortgage in 10 years. He renegotiates. He gets a modification. Then he defaults on that. He files bankruptcy, and they go back and forth, and it's been going on for 10 years.
I know like that. I've only heard stories like that on the tenancy side where people manipulate the tenancy board and then they just keep kicking the can down the road. Eventually they run out of runway, but you can go 2-3 years without paying a dime.
Oh, sure. New York is like that too.
Yeah, it's very similar in New York. I've heard a lot.
California too. I mean,
Yeah.
unfortunately, those 2 states. I mean, it happened to us. We own a property in New York, and it was a family friend. It took me a year and change to get him out.
And you just didn't pay anything.
Just didn't pay a thing.
You know,
I mean, I have a judgment against him, but whatever. It doesn't make a difference.
That's awful, man. And the rules are so skewed that like they're thinking they're protecting people, but they're actually not. They're giving them a reason to, be scumbags.
Well, you heard a lot of these stories back in 2008 with the crash. People were in houses for a long period of time without even having to pay.
Yeah, well, they couldn't keep taking all these homes back. I mean, if you saw The Big Short and great movie,
Yeah.
but that's exactly what happened. They just couldn't take them back. And, the risk of kicking them out, what happens? Your home sits vacant. You risk people breaking in. You risk all these other things happening. So it's a catch-22. What do?
Especially in the northern states, you want the heat to stay on so
Sure.
pipes aren't bursting and whatnot. Yeah.
And then,
yeah.
Once they take them out, people just rip up the whole house.
What was it like living through that market? Both of you. I'm curious. What was it like for you guys on the ground?
I mean, I said being in the construction field, I mean, we just died. I mean, there was no more work. As far as seeing homes that they were just going in because, people weren't working, they were ripping the copper out of houses. I mean, you
And doing
literally,
what with it?
they would sell it to the scrap yards.
When
When I tell you lines, there was Two Brothers Scrap Metal where I lived, lines down the street with copper. They would just go in houses, break the sheetrock, rip all the copper out, and they would bring it to the scrapyard. Everybody knew what they were doing, but these people were just running out of homes. I was in Florida in 08, 07, 08, 09. And I mean, you would literally drive down the street with 20 homes and 8 homes would just be vacant. People were so scared, they were just picking up and leaving. They couldn't afford the mortgage. They didn't know about the whole foreclosure thing. They didn't want to have to, move out in the middle of the night if they came and told them, hey, you got to be out today. And there were just vacant homes everywhere. It was scary.
See, that you'll never get in Canada because of the regulating banking industry and how next to impossible that would actually be. So, I mean, when all that stuff happened, nothing happened in Canada. It was steady as she goes because of a regulated banking. Everybody was like touting its benefits, and honestly, it paid off significantly because there was no volatility plugged into the formula. We held harmless on that. Now people got smoked on the equity markets and lots of money left the markets as a whole, but that never happened in Canada. They actually it became like the safe haven for a lot of people.
For us, I remember, my dad had homes that we'd have to hire a security guard with like a Rottweiler crazy dog, and they would sleep there.
No.
Yeah.
To do what? Protect the copper?
Protect them from breaking into the home. And, a lot of the speculators that were buying and selling homes back then, before, because you do your walkthrough, and a lot of times deals would get delayed because someone would break in and something would happen. They wouldn't put in all of the appliances till the day before or just the day of the walkthrough. A lot of things happened back then.
That's insane, man. That's Wild West stuff.
Yeah, I mean, it's definitely different now than it is before. I mean, you don't actively see, for sale, foreclosure anywhere.
I knew
mean,
a couple of people that were telling me that they were literally buying properties on auction using a credit card. They were just like 3,000, 5,000, 4,000, 1,000, 10,000. They were just buying. And then they all made out like bandits in the long run, but they could also carry it, because I know that if at that time, if you basically just paid your back taxes and certain things, I've heard stories that in Detroit, like in the city, there were office towers just out.
you could buy a home in Detroit for $1,000.
I bought a house in Detroit around that time with a couple of my buddies. We made it kind of like a road trip. We bought a house there for $20,000, put 20 G's worth of rehab, and then it started to grow. We sold it for about 90, but all in all, it was definitely not worth it. But I mean, for a house to sell at $20,000, like, I mean, you couldn't replace that entire property for $20,000. I'm not even talking about the land. I'm talking about just the recoup build cost back then.
Wow.
Right? It just didn't make any sense. But I remember also walking in with a realtor. It was three big guys, the realtor, and then he cocks his gun, and we walk into. We do a walkthrough.
That's a walkthrough.
Yeah, that's a walkthrough. Right? I'm like, you know what? This isn't for me. I don't want the money that bad.
But imagine how many billions of dollars that was, and that's 3 million homes, but the values were nowhere near where they are today.
Not even close.
Right now, they're estimating it's $70 billion of shadow inventory.
70 billion.
70 billion. That's just an estimate. No one knows for sure what it is. But if you really look at today versus back in 2008, 2009, 2010, things were affordable.
That's true. Very
Interest
true.
rates were nowhere near where they are today. And if you look at the overall dynamic, people can't afford their homes now. And with this shadow inventory, people thought they had a shot. People were saying foreclosures. Investors aren't getting them. The average person's not getting them. I mean, if there's a calculation that they do, and it basically takes the price of the home divided by your income, gives you a ratio of what's affordable and not affordable. So back in 2008, the ratio was 4.7. Today, we're at a ratio of close to 6, 6.5.
50% increase.
Yeah. It's crazy. We're at a 6.8 to be
What
exact.
scares you the most about this?
I'll tell you first what makes me happy is that people are qualifying very different than they were in 2008.
Good point.
So people actually can afford their homes. And secondly, what I also am very happy about, there's a lot of equity, the highest amount of equity built in homes than we've ever had. So those are the two big positive factors that really offset any of the major negatives. But the negatives are your affordability is a big problem.
Cash flow.
Not just cash flow, just as a primary residence for someone to look to buy. If you talk to the younger generation, 50% of them don't even think homeownership is a reality.
Yeah.
I know. It's terrifying. And depending if you go from state to state, that gets worse.
Yeah. And then you have just people, even cash flow, rents. Rents are so high too. I mean, people are renting in Manhattan for a 1-bedroom paying like $6,000 a month.
I remember the first time I was in the city. It was New Year's. Came down with my buddies. One of my buddies' older brother. We must have been, I think we were still in high school, first year university. And he was, 2-3 minutes walk from Central Park. Walk into his place. It was maybe, 1,000 square feet. And they somehow chopped that thing up to 4 different apartments within that one apartment. And at that time, he was telling, like I'm talking about 20 years ago, he was paying, I think, $12,000 a month for, first of all, the kitchen was the size of a powder room, Like it was just
Yeah, they were always
just a
super
hot
small.
hot plate,
Yep.
and I don't even think they had a dishwasher, and people were paying it. How? I have no idea, but it was crazy. It never made sense to me why people would do that. Made no sense to me whatsoever.
Listen, you know what? Also, the biggest thing that scares me though is the commercial market still hasn't even been addressed.
Yeah, so that's
Why
an
is
interesting
that?
one. That's an interesting one. I've heard about this commercial loan cliff now for almost 4 years. People think it's going to fall off. People are going to have to refinance. But I think it goes back to what you originally said: is the equity, and there isn't nearly as much commercial real estate being acquired. Everybody thought there would be a flood out of buildings because of COVID, and everybody's working from home and all that stuff. But that it's somewhat supplemented. I don't know if that's happening. And then if you go locale specific, which you have to be, like Boca, for example, we're looking for commercial real estate. My wife and I, it doesn't trade. There's nothing here.
No, you're not going to get that here because unfortunately it's owned predominantly by one or two.
So it's the same as this banking situation where some, inflating, creating a market, hoarding, buying. But that's nothing wrong with that. That's capitalism at its finest. But I don't see this cliff because there's so much money sitting on the sidelines that if there was some sort of dip, they just buy it all up.
I don't even think it makes it that far. That's the sad part. An average person doesn't have access to shadow inventory, doesn't have access to that type of property. They don't. Back in 2008, 9, 10, the REO brokers ran the market because they had so much listings, so much inventory, and you could maneuver in here, but they don't even make it past go.
Can you explain the subprime thing? I understand it. I know it. I don't think all of our listeners necessarily do. Everybody goes to The Big Short where a stripper owned 5 houses, right? She basically, what was it, ninja loans, no income.
Listen, I think I told the story once, but I was in California and the housekeeper of a friend of mine came up to me like in tears and said, "Mr. Meyer, I need to talk to you." I said, "Sure." She said, "No, in private. Give me your number and I'll call you. I want to see you." So she came to my house and she said, "Listen, I have a major problem." I said, "What is it?" She said, "I'm going to lose my houses." I said, "How many do you have?" She said, 5. Legit, she had 5. She made $400 a week. She had bought one house many years ago with cheap money. It was cheap, so it could, but she refinanced and cashed out and bought another one when the market was good, 2003, 2, 4, 5, leading up to everything. It was great. And then I said to her, "What happened?" She said, "They told me I don't have to worry about it. The renter pays the mortgage and you just take money from the house and that's it. You don't have to worry." And she was on these negative amortization loans.
How did they play out in practice? Can you draw on a real life example what a negative amortization loan looked like?
Yes. So what happened is you would get a loan and you had 4 options to pay. You had a negative amortization, which means it was like based on 1% or 1.25%. So every month, the difference between your actual rate and what you were paying would get tacked onto your mortgage.
So, all right, you bought a house.
If you started out with $500,000,
okay,
and every month you would go negative $2,500. So it would tack on 25
to the loan.
Correct. Then you could pay interest only, or you could pay a 30-year or a 15-year. Everyone paid the minimum payment because home prices were going up so much, so they didn't care. They would just refinance and use it as a piggy bank. They would go spend everything, $100,000, $200,000 on credit cards, cash out, and start all over again. And to qualify, they told her, "Don't worry about it. We'll get you a letter." And they would get a letter from some guy who would write a letter that says, "Yes, Ada works for me. She's been working here. She's a manager of my store. She makes $3,000 a week. I pay her." And that's it. That's all that was needed. You didn't need anything else.
Nobody verified, nobody checked, no payroll, nothing.
So crazy.
And at one point, what really was really the crazy. Deutsche Bank bought Bear Stearns' lending division, and they rolled out a program, 100% financing, 80-20, and you qualified with a 580 score, stated income, stated asset. That was like unbelievable to me. So you have all these people that can't qualify, can't afford a home, can't pay, just owning homes and doing. And then when the market hit, they walked away because you had 100% fine. No one has skin in the game. If you don't have skin in the game, there's no need to keep the home. Everyone said, okay, take it back.
And they were taking this so they can put it into mortgage-backed securities, sell those mortgage-backed securities,
Yeah.
and then you get.
And just like the Big Short, every tranche was graded A through junk, whatever, D, whatever you want to call it. And they figured out how to take these CMOs, collateralized mortgage obligations, and pair them off and make them, instead of junk, make them look like A paper. So institutions and everyone could invest in it. And unfortunately, all the junk, which was represented as A paper, was worth nothing.
A lot
what
of people went to jail, huh?
Nobody actually went to jail. There was one
Really?
guy who sat a little bit in that. So that if you watch the end of The Big Short, they had a straw man who sat, a little bit. I don't even know if he actually sat in real prison. Nobody went. Too big to fail. Big payouts, right, to the CEOs. I mean, it's kind of the things that people hate the most about. I don't have the same ideology towards athletes or executives that are making a lot of money and then they get paid out even when things go sideways. They still had to manage. They still had to course correct. Did they hedge the bet? Did they stop the bleed? These are exceptional people in what they do. Did they do unethical shit? Maybe. If they knew it, even worse. They should be charged. They should go to prison. But yeah, that stuff that I've heard this commonly about athletes and oh my God, these people are making 20, 30, 40, 50 million dollars a year to dribble a basketball. I'm like, no. That person is exceptional at what they do, better than anybody else. And whoever's paying him that salary, just like a good employee, is making exponentially more off that person.
Correct.
And I don't buy that at all because they dedicated their lives. And there's, behind that one individual, there is hundreds of thousands every year that didn't make it, that don't have those skills, and they're being rewarded handsomely for it. Just as a quick side, how many people, the NHL has been in existence for over 100 years, National Hockey League. How many people do you think played at least one game in the NHL over 100 years? Just take a guess.
10,000.
5,000.
It's actually accurate. 5,000 people through the history of the sport, of the national sport on this planet got to play. It's actually closer to 6, I think, got to do that. So yeah, they're going to get rewarded handsomely. I know I went a bit in a tangent, but I mean, I don't like that always just picking on that one person who benefited grossly. If you'd had negligence, you deserve to go to prison. Hard stop. I'm not justifying that.
Absolutely.
But some people do some things that are really exceptional and they're rewarded handsomely for it, especially in the United States.
Should be.
Just saying.
No, but that's different. But at the end of the day, what happened was wrong.
What happened to that lady, to that housekeeper?
She lost all her houses.
And what happened to her personally? Did she have to go declare bankruptcy? I mean, $400 a month.
That's
I don't know
it.
what
No,
assets they're going to go after. But.
No, they took all the houses. They foreclosed on everything, and she had to file bankruptcy.
Do you think something like that could ever happen again?
No,
Why?
because the way you qualify now, this whole Dodd-Frank and all of that came into effect because of that.
Right.
Because they wanted to make sure appraisers weren't colluding and mortgage brokers weren't colluding and this one, that one. The way people qualify now are legitimately real qualifications. Now, my personal opinion is an FHA borrower, conventional borrower is great, but if you have 3%, 5% skin in the game, you could walk away no problem. In the non-QM world, I'm biased because that's what I do. You're self-employed. You make money. You're an entrepreneur. You're penalized in the real world where you have to choose and seek alternative financing. But with that comes more security, more stability for us. You have more skin in the game. The average loan we do has at least 20% down payment, and the credit score is probably 720 or better. And performance-wise, they tend to make more money. I mean, think about it logically from a just a loan perspective. If you have a person who takes an FHA loan, that's a first-time home buyer loan typically. You can go as high as 50% debt-to-income ratio. So your mortgage payment plus your liabilities can be up to 50% of your gross income. Now, you're putting 3.5% down. God forbid anything goes wrong. Pipe bursts, your car breaks down. What's the first thing that they're going to skip a payment on?
Credit card.
I disagree. Mortgage, that's your biggest payment. If you have 10 credit cards and you know that can sustain you, that can help you do what you need to do, or you're going to miss your mortgage payment that's going to eat up 3/4 of your check or half your check.
You know, it's really funny you mentioned credit cards. When my parents immigrated and they were strapped for cash, my mom applied to all these credit cards and just kept moving one for another, and until we eventually caught up and started making money. But that's the only way she survived.
So that's exactly the premise of that is anyone who's stuck that has credit cards, they'll never default on their credit cards unless they absolutely have to. The first thing that's going to go, typically from my experience of 25 years, is the mortgage. Now, if you have 3% or 5% skin in the game and you really get down on your luck, you're going to, you're not going to think twice or 3 times or 4 times. You do what you have to do. But if you have 20% in the game already and you have a propensity to make money and you have a propensity of you have a business and you know what it is and it's hard to qualify to begin with for you, you're going to make damn sure that you have that. And we require 6 months worth of reserves minimum. You don't need reserves on the other stuff. It's a big difference. So qualifying purposes takes out a lot of that risk and that exposure.
The craziest part about non-QM is you're not getting penalized for making money. You're getting penalized for not paying more in taxes, which is a prudent tax planner or a business person. Like when I ask people about business, like especially younger people, I kind of try to stump them. I say, "What's your biggest expense in business?" They're like, "Overhead, rent." I'm like, "No, tax."
Sure, people don't realize.
They don't realize that it's the biggest expense. Like you ask somebody, "What's the ingredient in potato chips?" They'll tell you salt and whatever else. No, it's the potato, right? That's the biggest ingredient. So then you look at things like that. If you're a prudent business owner, you shelter as much as you can within your business legally, draw down, take down what you need, expense what you're allowed to legally expense. But when you're looking at trying to qualify for a mortgage, you're not making enough because you're not paying taxable income enough to sustain the cash flow, which is absolute bull, right?
100%.
Which is why the non-QM space is growing, why the gig economy is
I
growing.
was just going to say that whole gig economy concept where 10 years ago it wasn't even a thing. I mean, 10 years ago, I remember very rarely would you see, people going from job to job hustling like that.
Right.
Just wouldn't see it. Now, it represents a good portion of our business. These are people that are going from job to job that a traditional bank they go to, they can't. If they wanted to buy right now something that's on shadow inventory and they went to Wells Fargo, who's the lender of choice over there, Wells Fargo is not going to be able to qualify them because they don't even understand it.
So if you're armed with that information, now you know that there's inventory stock being held by these large banks. I, as an individual, who would I reach out to or what would I say? I want to buy in on this.
So that's a great question. So a lot of times, people can call. I don't know how far you'll get, but you can call, the big banks and try to get to their REO department and find out where the brokers are, who their brokers are that they're giving these properties to. You have to be very big hedge fund or something to buy directly from the bank. But typically they have brokers that they give these assets to. And, you have like an account with them. You're a preferred vendor for them and they give you allocation based on your status, based on how well you perform. And they grade you on every deal that you sell ultimately.
And do they sell them in blocks?
No, typically no. When it gets to the REO broker level, no. It's typically sold house by house by house because they get listed on MLS.
Right.
And it goes through that process. But ideally is you want to find the people that they're getting to and get to these brokers and say, hey, I have money, I have proof of funds, I have everything you need, I can close quickly, I'll pay full ask or close to it, whatever it is. I'm not looking for a crazy deal. I'm just looking to get an opportunity. And that's how you do it. Because if you try to negotiate, oh, because it's a bank-owned property, give me 30% off, they're going to tell you no. There's so many other people waiting for the property that'll pay everything. So sometimes you're going to have to look and see what it is and what the opportunity exists. But you have to be a hustler. You have to go out there and make the calls and make the connections so you can get access to those properties.
You get a lot of wholesalers that kind of middle to middle, one of my sayings, right?
Yeah.
Because they'll go and call and find out. I mean, this would be a great opportunity for them. And they tell the banks, look, you don't have to put it on the market. You don't have to pay a broker. You don't have to do any of that stuff. We put it in between. Give me, a 10% lift on it, 5% lift. And then they go and sell it to somebody at a, 2%.
If the numbers make sense, for sure. It's
There's always
cheaper for them to do it that way. But if it's not and they have to put it onto the market, then they'll just factor that into their costs. And a lot of these foreclosures that they've taken, home prices have gone up systematically. So whatever the deficit was, they've made it back now.
Right.
So
On the construction side, are you seeing an uptick?
Right now?
Yeah.
No.
Steady?
Not even. No. People are hanging on to what they have right now, and they're just it's the wait and see game.
You think rates will have anything to do with that?
I think that unfortunately, in the world we live in, the news has a lot to do with it. And the news is scaring a lot of my clients. And when I talk to them, that's where they're getting.
What's scaring them?
It's scaring them that it's unstable right now. The market's not stable. They don't know if with the tariffs have a big thing to do with it. Is material are they gonna start a job, and let's say it's a decent sized project, and halfway through the job, because you can't buy all the material the first day, is the material gonna go? Is it gonna double? Is it gonna triple? Is it going to go up 100%? And you can't find a contractor that's going to right now give you sign a contract with you, not stating that if material goes up, that the price is going to go up. They have to. They can get killed on the job. So what do people do? They say, you know what? We're going to wait. Unless they really need to do it, unless, something is going on and the doors are rotted out and they have to change them. But any kind of big project right now, kitchens, they want to do an addition, or they're going to redo that bathroom, they're holding off on right now. They want to see what happens. I mean, that's basically what everybody's saying. I want to see what happens.
It's usually the canary in the coal mine.
Absolutely.
Tomorrow's, just people want to see what happens tomorrow anyways with the Fed coming out. Personally, like I said, I think it's going to stay the same. I know you're optimistic, but needless to say, people just want to have a little bit of confidence that things are going to be okay. I mean, the stock market is starting to.
Although today was a bit of a bloodbath.
But you get that.
Yeah. I told you don't. I was saying before, don't buy that last couple of weeks where there was normalcy, because there's still a lot of skittishness in the market. And you're seeing that's the construction end, right? But let's say tomorrow we get a 50 basis point cut, which won't happen. I'm calling 25. I got optimistic at 50. Okay. Do you think that's actually going to move the needle?
No, but it's going to create confidence. Rates are not going to, just because a quarter point comes down on the Fed funds rate, that doesn't correlate exactly to
common
the
misconception,
mortgage rates.
right?
One thing has nothing to do with the other. Fed funds rate is bank to bank. Ultimately, will it cause a momentum shift where there'll be a flight to, where there'll be a stock market rally where the bond market will take a little bit of a hit and rates will improve? Yes, I think, but it's not going to be a quarter point. I think the overall optimism, though, will change. The overall general consensus of, all right, the Fed thinks things are going to be okay, so they're going to start lowering rates. Right now, everyone thinks the Fed thinks it's still a problem. Inflation's a problem. Everything's a problem. So until they get that sigh of relief, all right, Fed Chairman Powell says we're going to be okay. He's dropping rates. So that's the fundamental misconception that, that's the end all to all end all.
Right. All right. Well, I had no idea about this topic in that much detail. Thank you very much for sharing that and scaring the shit out of me.
Yes. Thank you for that.
I appreciate that very much. So, do you wanna close us out here? Do you got any words of wisdom?
Yes. If you're in the market to buy, obviously you want to try to get the best deal, but more importantly than that, make sure you know what you're buying and where you're buying. Like you said, always.
It's a lifestyle choice.
It's a lifestyle choice. If that's your primary residence, make sure you know what you want. And if you're an investor, the numbers have to pencil.
Yeah, and you have to be able to ride it out. You don't have real liquidity like you do in the markets. If you're looking to buy and make money from today to tomorrow, real estate is not your play. If you're looking
The
at
long-term play.
yeah, 3 to 5 year time horizon, even if you don't see that capital appreciation, but the numbers pencil and the rate and the rent covers your expenses, you're paying down all this equity. But I mean, you look at the historic values of equities, including real estate, they slope upwards. They have these little dips, they have these ups and then anomalies. But there's checks and balances within the mortgage industry right now. So the likelihood of a subprime fiasco happening again are almost slim to none. I'm sure somebody will come up with some sort of nonsense to try to monetize, and we'll catch it by the time it's too late. And if it wasn't for Michael Burry, I don't even know if it would have been caught. He bet the other way where the bet didn't even exist. He created the bet.
Yeah.
Yeah.
Right? All right, guys, we'll see you tomorrow.
Take care. Thank you.
Thanks.
Nothing can stop me. I'm all the way up. All the way up.